Hey everyone, welcome back to Future Funded, where we make money talk make sense. Today we're going to be talking about investing using snacks.
Let's just hop into it. Okay, so what is investing? Investing means putting your money somewhere now, like in stocks, real estate, or businesses, so that it grows over time. Imagine you have two choices. You can either eat all of your snacks now or trade them for a whole snack buffet later. Right? Sounds nice. All right, so one thing that we have to keep in mind when investing in the stock market is the risk and reward. Every investment has a risk. That's like choosing between trying a mystery flavor jelly bean, you know, those Bean Boozled ones. It could be either amazing or really disgusting. And, you know, if you get the really good tasting one, it's going to be awesome. You're winning big. But there's also a chance, a 50% chance, of getting the disgusting jelly bean and feeling like you want to throw up. High risk can mean more reward, but more risk of losing your snacks as well, right?
Have y'all ever seen those snack mixes at the supermarket where it has not just one thing like peanuts, but it has raisins, pineapple? All right, let me stop going off topic. But that's really what diversification is. Making sure you have multiple things, so if one thing goes bad, you have other things that you can enjoy.
Okay, investing early lets your money grow on top of itself. For example, like planting a cookie tree that grows even more cookies, right? They grow into even more and more and more cookies. That's compound growth, and it's why starting young matters. Okay, so I just wanted to use a real life example. So over here is an actual screenshot from Yahoo Finance, and that is the website that I recently just started using to start reading stock charts. And I wanted to give an example. Say you bought one share of Nike for $72.98 at age 16. Now, if it grows by 10% every year, in 10 years, it could be worth about $200, and that is just one share, right? So on the right, I just wanted to go over what these words might mean. So these four terms are, I would say for beginners, the most important things to read when looking at a stock chart. So first, it's a PE ratio. So this shows how much money investors are willing to pay for every dollar the company earns. So if you have a lower PE ratio, it would be an undervalued stock. So this would normally be below 15. So in this case, the PE ratio is 33, right? And that is actually a higher PE value ratio. And that means that the stock could mean it's overvalued and it's expensive. Typically, these are above 25. And an average PE ratio would be about 15 to 25. Okay, so you want to also look at the market cap. So I would say that a stock that has a market cap above $10 billion is normally safer. So a higher market cap just means that the company is stable and established, and it really, what it means is it's the total value of the company, how big the company is. Okay, next I want you guys to look at the 52-week range. That's going to be right over here. Okay? And what this would tell you is it shows the highest and lowest price that the stock has been in the last year. So this is useful to see where the current price is within that range. So in this case, we see Nike is okay, it's actually right in the middle, 52 and 90. And if the price is closer to the lowest point, it could be undervalued. And if it is closer to the highest point, it could be more expensive, right? Lastly, dividends. So remember, this means that the company is giving its investors a reward. It could be, normally I think it's every year. So in this case, Nike does give its investors a dividend, and the percent rate is 2.25%. I think stocks or dividends is always great because it's income that's just going to be coming towards your account, right? Lastly, I want you guys to, just for beginners, right? I mean, and in general, advanced investors probably also do this. They definitely look at the 1 year chart. So that'd be the one right here. Okay, so I just wanted to show you guys the 1 year chart. So over here we see Nike's is going down, and since it's in red, it even helps us better. So, okay, for over 1 year, maybe it looks kind of risky, right? And over the past 5 years, okay, it's also going down. So we see that the trend is actually generally downwards. And we can look and see, okay, the stock did bounce back after that drop.
Now I just want to give a disclaimer. I myself am a beginner regarding trading, stocks, anything of that topic. I just wanted to provide you guys this knowledge just to have a foundation and just keep on building that knowledge, right? And feel free to share this with your friends, your family, because we all want to be able to make that generational wealth. Am I right? Thank you guys so much for watching today's episode. I really hope you guys enjoyed, and I'll see you guys in the next video. Bye.